McDonald's is now trading at its 52-week low, and it is one that I added more of into the portfolio. It is down around 17% over the last 12 months. Now, there are a few reasons for this, one of them being the continued boycott from customers across the Middle East, which has hurted their top-line revenue. There are also a lot of discussions in forums, on Twitter, on social media, where a lot of customers are raging because this company is now seen as a luxury. A lot of price items have been hiked. In fact, we can see they've raised their prices by 10% in 2023 alone, higher than essentially inflation. And we can also see here that McDonald's are planning to step up some deals. They have recently introduced a $5 deal, I believe, to essentially help with the slowing of the fast food traffic into their stores. Now, I like this company. I'm going to discuss why I believe it is a great buy right now. And one of the reasons that we can see straight away, their dividend does look to be safe, a score of 77, and their growth, as we're about to see, double digits or thereabouts just in the more recent time of October 23. So we are anticipating an increase over the next few months. When we take a look, well, their dividend safety was reaffirmed not too long ago, so a dividend cut does look to be unlikely. And for those that want to see one of the large reasons why for me this is something that needs to be in everyone's portfolio, it's the recession return. Now, we go through a lot of companies on this channel, and this is up there in the top 5. They had a negative 3% return in the last Great Recession 07-09 when the S&P had negative 55. On top of that, they also increased their dividend during that period, and they had marginally better sales, negative 6%, with the S&P's negative 12. On top of that, when we look at dividend growth, McDonald's is right up there, 9.9% in October, 8% over the last 5 years, and a cool 15% over the last 20. This is truly a dividend growth company. In terms of the number of years, well, look, they've been increasing their dividends for 47 consecutive years. If they increase it again over the next 3 years, which will be very, very certain in my opinion, they will very soon gain dividend king status. When we talk about dividend yield theory, now as always, this does show us a company is undervalued when the current yield sits above the 5-year average. We have an undervaluation signal, 2.74 versus 2.28. Also on the forward P, 19.8 when the 5-year trailing average is sitting at 25.4. So that is a double undervaluation signal, although we do note the consumer discretionary sector does sit much lower at 13.4. Now, when we talk about this company, one of the things that we like to look at is the free cash flow payout. Can they continue to increase those dividends? Below 50%, the preference for restaurants. What we see, it has been decreasing over the longer term. 63% in 2023. Now, for me personally, 60% is okay. Over the next 12 months, expected to come down to 58%. So in reality, I would be surprised if we don't see at least this October a high single-digit increase to the dividend. In terms of free cash flows, very important. We want to see increasing consistent free cash flows over the longer term. This is exactly what we see with McDonald's. It has more than doubled over the last 10 years and anticipated to continue that upward trend over the next 12 months. The next thing we like to look at is the sales growth. Now, this is an area of issue historically for this company. We can see from 2014 to 2020, pretty much for the majority of this part, they did have negative growth. Now, in the more recent year of 2023, they did increase their top line by 10%, but this is an area moving forwards that they will start to struggle. As we've seen, the boycotts, the increases in their price have started to turn people away. So definitely something you should consider in your investment thesis, as well as your margin of safety that we are about to come onto. And as you can clearly see, it did come all the way down to 19 billion in 2020 before picking up to around 26 billion in the more recent year. Another thing I like about this company is they do some share buybacks, which is part of their capital allocation that we will come onto in their investor presentation. They return excess cash to investors. As we can clearly see, it is decreasing over the period. ROIC, again, very important. Typically, I don't want to be investing in any company if it isn't a minimum of 10%. We see for the industry, it sits about 12 for restaurants. That is pretty much year on year looking very strong. Last 3 years, even in the low 20s, makes it incredibly attractive for investors. Remember as well, this metric does show us that essentially management have that ability to effectively allocate their capital. Another great thing that I like to see, not only is this above 16% in terms of their margins, and it is something they highlight within their investor presentation, but they have been able to show operating efficiency over the longer term with margins increasing. Now, this is something we talk a lot about, for example, when we review Nvidia. Not only do they increase their top line, but they've also been able to increase their margins, and that is something we really like to see for any company that we are considering investing in. On top of that, the same story to be said with the free cash flows, moving in the right direction, very high as well, 29% in 2023, looking very, very positive. Now, there are always things that we do like to see companies improve on. One of them is this, which is the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. We want below 3.5, and why this is important, we include it as one of the staple metrics to review. It correlates to balance sheet strength and dividend safety. Now, 3.13 is fairly high, although as we can see, 3.5 is the maximum, expected to be there or thereabouts over the next 12 months. So again, we do want to see this lower, ideally moving lower every single year. Just something to keep an eye on, as we said, does correlate to both dividend safety and balance sheet strength. Now let's go back to the historical performance. As we said, over the last 12 months, it is down 17% for reasons we have touched upon. But over the last 10 years, even after the drop, as we can see, 52-week highs of around $300, it is still up 147% over the last 10 years. And when we do come to compare it to the S&P, it has outperformed the S&P over the period. In terms of forward yield, well, it is looking nice around that 2.7% level. Forward P, as we touched upon, is around more 19.8 to be accurate, well below the S&P, which is around 23. And we also get a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. Now, when we take a look at their revenues, as we already touched upon, but we can clearly see here, we want to see increasing over the longer term. And as we saw, and in fact graphically shown a lot better here, it hasn't managed to increase over the longer term, something that we do really want to see management take initiative in. But what we can see over the shorter period from 2020, as we saw earlier, the lows of 19.2 billion, it has managed to overall move forwards. And we want to see at least a minimum of 4% ideally year on year, just to keep up in line with inflation. Otherwise, in real terms, it's not increasing. What's interesting to note, even the fact that they haven't been able to increase their top line, they've been able to increase their bottom line net income nearly double from 4.8 billion in 2014 to 8.5 billion. And we can see that graphically, while inconsistent over longer term, regardless of their top line revenue, which looks fairly flat, they have been able to become more profitable as the years goes on, which helps with returning a lot of excess cash to investors, whether that's through their dividends or their share buybacks. So there are some things to consider with this company. The next thing we want to talk about is the health of this company, their total cash versus their total debt. Very important for a quick health check. 2.1 billion of cash and short-term investments in 2014, 838 million in their latest quarterly report. So we can in fact see just from the last few months it has dropped significantly, and over the longer term it is essentially very, very inconsistent. Now, as always, in isolation this number doesn't tell us anything, it is completely useless, which is why we do compare it to the total debt numerically and directionally, which is a little bit of a worry. It has increased massively, 15 billion in 2014, 51 in that latest quarterly report, and as we can clearly see on a graphical basis, the debt is moving up. Now, one thing that we do want to say, when we did look at the net debt to EBITDA of 3.1, it is still below the maximum of 3.5, but again, these are considerations that you need to put when you are doing your own due diligence and looking at your own investment thesis. Next thing we want to see is how has management performed historically and what are the future projections? Well, out of the last 4 quarters, they beat 3 of 4. In fact, the last one was a miss. So 75% track record. Does that give you enough faith to essentially have agreement with their forward projections? Well, the next quarter they are anticipating low single-digit decrease to the earnings per share year on year. The next 3 after that, though, positive, although fairly minimal. And if they do hit the earnings per share estimate of December 2025, forward P will sit at just below 19. Again, whether or not you have confidence, something you need to come up with yourself. Now then we move on to some of their gradings. First one is the valuation grade. Now the main reason why they get a D-, as we can clearly see, the P on a forward basis of around 19-20 is higher than the sector median of 16. So they are trading right now at a premium of 28%. Whether or not you believe that is justified, whether or not you believe that is warranted, again, that is something you will need to consider. But the main thing to highlight here is that on whichever valuation method you look at, whether it's price to sales, EV to EBITDA, EV to sales, they are currently significantly higher, basically paying a premium for this company than those in the sector. When we then move on to looking at their growth grade, now they get a D+ overall. First thing we want to say, look, year on year, they're up 10%, sector median around 2.3, so that is a lot better. Forward looking, again, around mid-single digit growth, slightly higher than the sector median of 3.8. The main reason why we do see that D rating is the fact that the earnings per share isn't anticipated to grow as much as the sector, 6.3 as we can see here, sector around 10.96%. Now where they really come into their own here is the profitability at an A+, their gross margin 57, significantly better than the sector median, their bottom line as well significantly better at 33% versus 5%, so if they are able to tackle the issues of not having that footfall within their restaurants, then this margin really highlights that this company can continue to propel both on the top line revenue as well as bottom line net income. We then also see their cash from operations in 9.6 billion, a lot higher than the sector median of 278. So as a quick wrap up for this part of the analysis, we have a double buy seeking out from Wall Street, a hold from Quant, D- on valuation, D+ on growth with an A+ on profitability. Now what's always important, just to have a quick look, is there an issue with the sector? Is there anything we should really be aware of by comparing it to others? We have here a few in the restaurant industry space. I'm sure a lot of them you have heard of, and most of them we have covered ourselves. Well, look, over the last year, this includes reinvesting those dividends. For McDonald's, you would be down around 15%. But what we do notice here, half of these companies, half of these restaurant industries, similar to Starbucks, MPNGY as well, have been negative. So you could argue that the industry as a whole has suffered, whether that's through the boycotts or the lack of consumer demand. When we expand this to the last 5 years, well, look, McDonald's has gone from one of the last place companies to actually the second, although we do see that CMG is quite a winner by a large distance. And when we zoom out to the last 10 years, well, we can see McDonald's MCD the second best performing as well. So there is a lot to take from this information. Is this just something that is in the short term is an issue and they will be able to, like they have historically, turn this around? The main thing that I really want to point out though in today's episode is yes, it's good buying companies, McDonald's or any others, but do you believe that over the longer term it will outperform the S&P? Look, in the shorter term, as we can see, McDonald's has in fact underperformed the S&P over the last 12 months. These are all reinvesting those dividends. However, when we zoom out, even over the last 5 years, the answer is the same. But over the last 10, we can clearly see that McDonald's has outperformed the S&P 500. Now, just because it has done it in the past, remember, past performance isn't any indicator of future performance. It's just something that we can look back on and say that they did very well. Can they do it again over the next 10, the next 20, whatever your essential investment strategy is? Again, something you need to consider. Now, this brings us on to the insider ownership, which sits at 0.23%. As we can see, 12.45 million worth of sales by these insiders. And we can see 6 of these have sold over the last year. In fact, 372,000 in the more recent quarter. When we go to Q2, again, a lot more selling at 1.1 million. Now, I would argue these are fairly trivial amounts, so in fact, it doesn't really mean anything, personal financial reasons. And we can see here the more recent one, the EVP on the 3rd of July sold just under 1,500 shares for around $372,000. Again, completely up to you whether you want to include it or not. For me personally, just something to be transparent, show buyers and sells, but realistically, buyers are a very bullish signal. Management buy because they believe the share price will go up. Sales less so in terms of a bearish indicator, personal or financial reason. We then move on to institutional ownership, just above 70%. 8 billion worth of sales over the last year, a lot more buying, although you can argue the majority of that buying did come in quarter 2, around 139 to be exact. In terms of the more recent quarter, while still marginally, but still more buying than selling, again, the same to be said in quarter 1. So yes, insiders have sold more over the last year. Yes, institutions have bought more, so you could argue maybe conflicting data. But as always, do your own due diligence. Never copy what insiders or institutions do. Now, just before we jump onto their investor presentation, we've released 18 undervalued Dividend Kings. With this article, you get a free spreadsheet that runs through all Dividend Kings, a lot of information. Again, if you want access to this article or any others, it is all completely free and you can start reading straight away by clicking on the pinned comment below. Now, just before we go into the valuation, few things that we want to highlight. The first one is that McDonald's in their investor presentation talk about having 50,000 restaurants by 2027, and what they talk about is growth around 4% in terms of stores in 2024. 2024 and around 5% per growth in 2027. So this is one of the things they are looking to do, still open up more restaurants. Whether or not you agree with this, whether you actually believe that this company needs to focus on other things, this is something that they are looking to do. And as we can see, a run rate of around 1,000 openings combined in the US and IOM. Next thing here that we want to point out, although we have already covered this, it is just part of their investor presentation, which I like, means it is important to them. They have shown nice operating efficiency, 43% in 2019, 47% in 2023, and their target is beyond 2024 to expand that margin. Always a great sign, and mid to high 40% range. So look forward to seeing in their annual report for 2024 whether or not they did execute on that. Next thing is the capital allocation. Always great. If you have any companies that you invest in, go to the investor presentation, look at the capital allocation, see whether or not you are happy with the way they use that capital. First thing that they have here as one of their priorities is investing in the business to drive growth. Always a good sign. Second one here is in terms of the remaining free cash flows through dividends, and as we saw, they do some share buybacks. Again, nice way to return excess cash to investor pockets. Now this leads us on to the intrinsic value. Today's episode we get to $293. We're just going to run through how we got to this number and then start our margin of safety. First one is the multiples valuation. Companies in a similar sector and size, their PE, the average PE multiplied by the EPS to get to our intrinsic value. We have our first signal of undervaluation. We then move on to the DDM model. Nice growth rate in terms of the dividend, 7.6 over the last few years. We've gone a lot more conservative, 5.75, even lower than the more recent increase. Then we have here a very large undervaluation signal. And then we move on to the DCF model, where we have the free cash flow year on year, growth rate around 11% in line with analyst targets, and that discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by those shares, and we can see a third and final undervaluation. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers for any company your heart desires. So our intrinsic value of $292, the average of these three models, and with a current price of $244, we always use a margin of safety. Now whether or not you're happy with the inputs we've used, we are using this added layer, and we always like to start off with 10% and execute on that if it meets that 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. Look, if you believe that, it is a buy up to $263. Then we keep going till it's near the current trading price, and in today's episode, it isn't at a 20% MOS level just yet, but we can see it is sitting somewhere between a 15 to 20%. You could argue maybe more towards the 15. In terms of Wall Street, well, they are very bullish. They have 26% upside. In fact, their price target over the next 12 months of $309 is larger than our calculated intrinsic value of $293. Now, as I said, this is one that I already held from before. This isn't a new position. I've just added more to the position. It is one I do like a lot over the longer term. It has historically outperformed the S&P. There are a lot of positive metrics that we ran through, but as always, there are also things that you need to consider. Not every company is going to be 100% perfect, and you have to weigh up, one, whether or not you believe it will outperform the S&P, and two, if you believe this is a high quality company, and ultimately, three, the valuation. Do you believe at a 15 to 20% MOS level based on these estimates and judgments, it is one to add to the portfolio. So as always, interested to hear your thoughts below. Is this one you're also adding? Maybe it's on your watch list, you want it further down around 20 to 25% MOS, or maybe for whatever reason this isn't one you're looking to buy. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.